was largely a result of our decision to scale back the grocery category to reduce operational complexity and support our margins. Other revenue was down 9% year-on-year and up 2% on a constant currency basis, partly due to the suspension of our logistics as a service offerings in a number of geographies. Let's now unpack the growth dynamics of our marketplace revenue. Marketplace revenue reached an all-time high of 41.2 million in Q4 22. Commissions was the fastest growing marketplace revenue stream, up 81% year-on-year and up 105% in constant currency, reaching a record of 16 million. This was the result of commission take rate increases implemented in Q2 and Q3 22. Marketing and advertising was the second fastest growing revenue stream, up 76% year-on-year and up 96% in constant currency, reaching an all-time high of $7.4 million. This was driven by the strong momentum in third-party advertisers' revenue, which more than doubled year-on-year. Value-added services also reached a record high at 9.5, up 11% year-on-year and up 27% in constant currency as a result of a strong increase in warehousing service revenue. On the other hand, fulfillment revenue was down 23% year-on-year and down 11% in constant currency as a result of the selected deployment of next-day free delivery earlier in 2022. We are currently making adjustments to the free shipping program. We are introducing higher minimum basket sizes and further restricting its geographical scope to support unit economics. The strong marketplace revenue momentum is driving an acceleration in gross profit. Gross profit reached an all-time high of $41 million, up 22% year-on-year and 38% on a constant currency basis. This also led to an all-time high gross profit margin as a percentage of GMV at 14.5%. And now moving on to costs. Fulfillment expense reached $24 million, down 21% year-on-year and 6% on a constant currency basis, partly as a result of orders declining 12% during this period. The ratio of fulfillment expense per order, excluding Jumia Pay app orders, which do not incur logistic costs, decreased by 17% from 3.24 in Q4 21 to 2.17 in Q4 22. As percentage of GMV, fulfillment expense dropped 74 bps from 9.2% in Q4 21 down to 8.5% in Q4 22. These efficiency gains are encouraging, and we are focused on driving even more savings with a number of initiatives underway. These include optimizing our footprint and logistics routes, improving warehousing staff productivity, and reducing packaging costs. Sales and advertising expense reached $18.5 million, down 41% year-on-year and 35% on a constant currency basis, as we continue to bring more discipline to our marketing investments. This led to an improvement of marketing efficiency ratios, with sales and advertising expense per order decreasing by 32% from $2.8 in Q4 21 down to 1.9 in Q4 22. As percentage of GMV, sales and advertising expense reached 6.5% in Q4 22, almost 3 points improvement year-on-year. We still have room to generate even more efficiencies by improving the relevance and cost effectiveness to our marketing channels. There is an important distinction I'd like to make here. Reducing marketing spend and seeking more efficiencies does not mean we are planning to sacrifice growth in pursuit of profitability. I do recognize that in the past, periods of faster growth came with marketing inefficiencies, and that's something we plan to change. We firmly believe that we can drive usage growth while improving unit economics and efficiencies. In fact, We have countries within our portfolio, such as Ivory Coast or Senegal, that are growing at faster rates than in the group, with much better marketing economics. And this is a model we intend to replicate across the group. Moving on to technology cost. We continue investing in our tech backbone. Tech and content expense reached $14.5 million, up 10% year-on-year and 20% on a constant currency basis. This was partly due to the higher hosting fees during the quarter. That said, on a sequential basis, tech staff costs were down 14% as the headcount cuts undertaken earlier in 2022 are paying off. We expect to drive further tech cost efficiencies as staff reductions continue to pay off and infrastructure optimizations start yielding results. Let's now turn to G&A cost. G&A, excluding share-based compensation, reached $37.1 million, up 16% year-on-year and 28% on a constant currency basis. G&A included $3.2 million of restructuring costs associated with headcount rationalization conducted during the quarter. Excluding restructuring costs and share-based compensation, staff costs were down 12%, both year-on-year and quarter-on-quarter. We expect these headcount reductions to allow us to save over 30% in monthly staff costs starting from March 23 as compared to the October 22 staff cost baseline. To wrap up on cost, we have made good progress in cost reduction in Q4 22. However, these only reflect a fraction of the work we are doing across the P&L, and we expect to drive more savings throughout 23, which is reflected in our guidance. Let's now move on to balance sheet and cash flow items. CapEx in Q4 22 was $2.8 million, mostly relating to logistics and technology equipment purchases. Net change in working cap had an outflow impact of $13 million, largely due to a significant increase in trade receivable and prepayment. This was mostly related to the prepayment of hosting fees for 23 to secure better pricing. Cash utilization for the quarter was $58.2 million, which is 6% decline compared to Q3 22 and 15% reduction compared to Q4 21. At the end of December 22, we had a liquidity position of $228 million, comprised of $72 million of cash and cash equivalents and $156 million of term deposits and other financial assets. I'll now hand over to Francis, who will walk you through our guidance on page 20.
Thank you, Antoine. We remain fully committed to accelerating our progress towards breakeven. For 2023, we expect adjusted EBITDA loss to reach between $100 to $120 million. At the bottom of this guidance range, this means cutting adjusted EBITDA loss by more than half versus 2022. The progress we made in Q4 22, alongside the initiatives we're currently working on, gives us confidence in our ability to hit this range. We have baked into this guidance realistic assumptions in terms of usage dynamics. The macro situation remains a headwind, so we essentially assume a continuation of the same usage trends observed in Q4 22. What's supporting the adjusted EBITDA loss reduction is significant cost savings that results from efficiency initiatives that are largely underway. With that in mind, we expect sales and advertising expense to reach between $30 to $46 million. At the bottom of the range, we're talking about a reduction of over 60% versus 2022. Antoine made an important distinction earlier in the call, and let me stress that again. Cutting marketing does not mean neglecting growth. In fact, we are doing thorough work on supply, logistics, and customer experience to drive sustainable growth for the long term. However, in the near term, the macro remains challenging, which is likely to continue to affect usage on the platform. And this calls for even more caution and discipline in cost management. In that spirit, we expect G&A, excluding share-based compensation, to reach between $90 and $105 million, compared to $122 million in 2022. The organizational changes conducted in Q4 22 will help us drive meaningful staff cost savings in 2023. Antoine and I took a number of decisive actions in the very first days of our mandate. Some of these were difficult, such as headcount cuts and business exits. But we believe they were necessary to set the business on a solid foundation to reach profitability. We are also driving a number of cultural changes at Jumia, fostering a culture of innovation with a sharper focus on cost discipline. We have also removed layers of central management and business complexity to empower management in Africa to own and drive their country's agenda, with a clear focus on profitability and long-term sustainable growth. There is very strong buy-in and commitment across the organization to deliver on our strategy, and we look forward to updating you on our progress on the next call. With that, we're ready to take your questions.
At this time, we will be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to be removed from the question queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment while we poll for questions. Your first question for today is coming from Luke Holbrook at Morgan Stanley.
Yeah, good afternoon, everyone. Thanks for letting me on the call. You've made a significant reduction in staff, 900 positions. You're halving your sales and advertising expense this year. I think you discussed consumers facing macro pressures. So I guess putting that all together, what are the assumptions that you're making from a top-line perspective to hit the adjusted EBITDA guidance this year?
So as we just said in the call, hi Luke, thanks for the question. As we said in the call, we're not giving a guidance on top line for this year, but in our assumptions, we basically do not forecast or foresee material changes to the trends that we've seen in Q4, to put it this way. However, we are working very, very hard to reverse the trend and to deliver much better top line than what we've seen in the past quarter, working on fundamentals of supply, fundamentals of customer experience, UX, and distribution.
Okay, understood. And just historically, we've had, I guess, supply chain issues and macro conditions blamed on underperformance in terms of profitability. From what you're saying, if there is a deviation on top line trajectory from what you're expecting, you'll take further actions. Is that correct? Just make sure that you're hitting that adjusted EBITDA kind of loss guidance. Is that right interpretation?
We will make sure that we hit the guidance, definitely.
Perfect. Thank you.
Your next question for today is coming from Aaron Kessler at Raymond James.
Great, thank you. A couple questions. One, just the decline in customers and orders on a year-over-year basis that you saw. I think you said that was mostly macro. Was there any other factors, though, including scaling back some of these initiatives that weighed on the kind of the customer and order growth in the quarter?
Sorry, Aaron, I didn't get the second half of the question.
Oh, yeah. Is there any other factors besides macro that drove kind of the decline in customers and orders, such as some of the newer scaling back some of these initiatives?
No, I think that there are many trends at play. I mean, definitely macro is the biggest driver. When you talk about macro, there are two big things at play. One is inflation, and the other one is supply disruption. So inflation, we mentioned, for example, Ghana that has 54% year-on-year inflation. This is obviously impacting purchasing power for our customers. The second big piece is hard currency, and missing hard currency in each of our countries that is impacted heavily ability to import in some countries, like in Egypt. which as a consequence is impacting our ability to get the right supply on the platform and the right lineup of products. So this is by far the biggest driver. There are also some other drivers. For example, we have made conscious and deliberate decisions to optimize and rationalize some categories, such as FMCG or Jumia Pay app. So we're seeing negative trends on those segments, but we know why, and this is a very deliberate choice. On the other hand, we have some segments and some categories that are growing because that are performing way better than the average because we've already starting the review of fundamentals on those segments.
Got it. And any more details you can provide on the nice growth in commission revenues in the quarter? I guess how much of that was kind of from higher pricing that you've rolled out or cutting back the level of couponing you've used previously as well?
Yes, absolutely. So in this quarter, we've reached an all-time high at 14.5% of gross profit versus GMV. That's mostly the consequence of commissions increase, and that was undertaken mid-22. We're also hitting a record level of advertising revenues. However, going forward, we will be very disciplined on monetization, and we'll take it more as a byproduct of scale. So we do not expect further commission increases in the near term, and we do not foresee material increase in gross profit margin for the future quarters versus Q4.
Got it.
But
Great,
basically, yeah. So a share of that is from sellers' contribution from advertising, and another share is from kind of mandatory take rate from commissions. That we want to be careful about because we don't want to hurt the economic equation of our vendors, and we want to make sure that the platform remains attractive for new vendors to join.
Got it. Great.
Your next question for today is coming from Lamont Williams at Stifel.
Hi, thanks for taking the question. Can you just, as you bring down sales and marketing expense for next year, could you just talk about the shift that you were planning in the marketing mix? I think historically you've done most of the mix has been performance marketing. Can you talk about how you're thinking about next year?
Yeah, so very good question. Thanks a lot. And let me give also a broader answer because it's a very important point. So we're indeed scaling back on sales and advertising expense. And as Antoine mentioned, we're cutting on significant inefficiency and may I even say waste from the past. And we believe we can do that because we see little correlation between marketing spend and growth of the countries when you look country by country. So we're quite comfortable going forward with this plan. But we're not just reducing stuff. We also have a very clear plan to enable sustainable growth with healthy economics. So while reducing marketing budgets, we're also launching much more structural actions with medium to long-term impact that are, of course, more difficult to execute than throwing money on marketing, but that will have the best long-term and the biggest long-term impact. So we're rebuilding the value proposition of our platform category by category in each country, focusing on key categories: fashion, beauty, electronics, phones, home and living. Basically, what we're doing is we're onboarding or re-onboarding the right brands and vendors, securing best prices and selection. This, I insist on this one. This may sound a bit basic and obvious seen from Western countries, but this is absolutely critical in emerging markets in Africa, where supply is a permanent challenge for both consumers and retailers, and it's a battle for us. Second, we're expanding to reach outside of our capital cities, to reach consumers outside of the big cities. So we're expanding the consumer base through a broader distribution network and more relevant marketing channels to target those customers. So to your question, we're adding to our marketing mix, much more on-the-ground activation, programs that are tailored for people who are not necessarily fluent with the new communication channels, who don't have access to the internet, for example, and who have many good proofs of concept from a number of countries that we can leverage there. And then we're improving CX, removing pain points such as pinning up returns, and we're doing a lot of tech work to improve our UX. We're not delivering, we're not planning on delivering new fancy features on the app. We are rather focused on fixing basics, fixing issues, and simplifying the experience. To give you an example, at the moment, we're working on fixing issues with our login process that was negatively impacting our customers. We prefer to focus on that rather than delivering new creative features at the moment, because we want to make sure that the UX is strong enough and supports our growth story. So that's the overall picture. And as part of that, changing the mix of marketing obviously has a it's very important. So what's happening specifically on marketing, as I was mentioning, so we're increasing the share of budget and management focus on the ground activation and marketing channels that are relevant for customers who are fully connected to the internet. So print flyers, local radios, on street activation and so on are very good examples. We are also scaling up our efforts and the tech focus in our CRM and our on-site improvement. We have we have huge customer database, and we can leverage it even more with better CRM tools and processes. So we're working on that a lot. And we're improving our on-site performance, so we make better use of the direct traffic on the platform. We of course still have paid marketing channels, but with much lower budget and with much greater focus on efficiency.
Okay, great. Thank you. Thanks for that. And just you talked about some changes or reductions in business lines and the digital categories. Could you just touch on that and what exactly you did with some of your digital business lines?
So in the past quarter, we've been deliberately more disciplined in marketing investments across the board, of course, and in JumiaPay and JumiaPay app in particular. So we have pulled back spend on some of the heavily promotional categories on the JumiaPay app, such as airtime sales and virtual sales, which as a consequence obviously has impacted the sales in this quarter. But as we're focused on getting better economics, we do not intend to subsidize heavily the growth of such categories in the near term.
Okay, great. Thank you.
This concludes today's conference, and you may disconnect your lines at this time. Thank you for your participation.